Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. You know, it's no secret, there are over 70 million baby boomers, or roughly 70 million baby boomers, who are currently retired or about to retire. And because of that, it is very important for financial advisors to understand the different retirement strategies that are available to them and their clients who are in or nearing retirement years. So I have on the perfect guest on today who's going to help us understand these retirement strategies and provide some insight into strategies that might not be discussed enough. But first, today's episode is sponsored by the award-winning Zephyr. Zephyr is a financial services solution and data provider, giving investment professionals the tools to plan, invest, monitor, and grow, enabling better service and client engagement to achieve their clients' financial and personal goals. So with that, let's move on to the star of the show. I am very honored to welcome Sal Capizzi. Sal is the Chief Sales and Marketing Officer at Dunham and Associates Investment Counsel. Sal, thank you so much for coming on the show. It's really an honor to have you on. Can you tell us a little bit more about yourself and Dunham?
Yeah, absolutely. And thank you for having me on the show. I think the pleasure is on our side. So Dunham is an asset management company, and we also own a trust company.
Okay.
So we're able to take a look at the financial world from two very different perspectives. One dealing with obviously the investments, but the other one is how do you use the investments? How do you use tax strategies? How do you use basic trust strategies to create a better situation for the financial advisor's clients? We deal strictly through financial advisors. We don't go out soliciting our own business. So really your audience is our bread and butter.
Perfect. So, you know, I talked a little bit about how there's over 70 million baby boomers that are either retired or nearing retirement. And so obviously it's very important. And understanding those risks, opportunities, and strategies as those baby boomers age. Can you tell us a little bit more on why it's so important for financial advisors to understand the opportunities and risks?
Well, so the opportunities are clear to any financial advisor. Baby boomers is where a large amount of the assets are. What's more important is understanding the risks. And he said 70 million baby boomers are at or nearing retirement. You know what, Ryan? You're looking at one of them. One of them is me, right?
I could hardly tell. Sal.
I know. What I typically do is tell people I'm 81 years old so that they say, "See, gee, Sal, you really look great." But the issue of being close to retirement, right, is a critical issue, because in my career, I cannot tell you how many times I've seen people literally at their retirement party, and then they are back at work because the timing of their retirement relative to the market just wasn't working well. And that has a name. We call it sequence risk, right? It's the sequence of return that you receive. And from my perspective, that's one of the most important things that a financial advisor has to take a look at. Because if the sequence of returns are unfavorable, what it basically means is that a retiree, despite all the wonderful planning that they did to accumulate assets, they can literally go broke. They can go bankrupt while in retirement, right? And a simple example would be this. Ryan, let's assume just for a moment, even though you're infinitely younger than I am, but let's just assume for a moment that we both retired at exactly the same time, right? And let's assume our returns were identical. In other words, let's assume for a moment that we had 10 years of a 6% rate of return, 10 years of a 3% rate of return, and 10 years of a 0% rate of return. Notice there's not even a negative return in there, because most people think of sequence risk as when there's a negative return. I retired literally on October 7th of 2000, or October 9th of 2007, right when the financial crisis began, right? It's not about necessarily a negative return, but it's the sequence of the returns that I receive. So if we had the 10 years of 6, 3 years, 10 years at 3, 10 years at 0, and let's assume that you started with the 6% first, then 3, then 0, right?
Yep.
You would be doing infinitely better than I would if the same returns, our same average rate of return, but I started at the 0, then went to the 3, then went to the 6. And it's simple compounding when your listeners think about it, right? So that is where the sequence risk really comes in. It's how are my returns relative, right, to my ability to achieve my goals. I would go broke if I had those returns. You would be fine, and you'd be able to retire and live comfortably if you started with 6, then 3, then 0. If I started at 0, then 3, then 6, I will go broke in my 80s. I'll literally run out of money, and I'll probably be living with one of my 2 girls, and I'm sure my son-in-law isn't going to be very crazy or excited about that.
Yeah, that's a very interesting scenario too, right? And as investor, you just have no idea what those returns are going to be moving forward. And then if you, like you said, Sal, if you start out those first few years with 0% return and you're taking income from that portfolio, you've taken that money out, you've locked in that loss or that 0% return, right? You can't, that money's not going back into, capitalize on that 6% return later in years.
Yeah, Ryan, you nailed it. See, the thing is, because I'm taking income out of my portfolio, that magnifies the loss. If you and I had the same returns during our accumulation phase, in other words, you started at 6, then 3, then 0. I started at 0, then 3, then 6, and we weren't taking out any income, we'd wind up at exactly the same spot. We'd have exactly the same dollars. But that's why what you just said is so critical. It's because we're taking out income from this portfolio, and what we're doing is we're now pulling it out of my portfolio. I never have an opportunity to do better with it, right? And it's the compounding. I did not do well at 0% rate of return. I'm depleting my assets, aren't I?
Yeah,
right?
yeah.
And that's where the sequence risk comes in. It's because of the income that the retiree is taking. It's the income when the matriarch or patriarch passes away, and now they left the trust for their kids, and the trust is generating income for the children, right? Anytime that you have income, being generated out of the portfolio, that your financial advisors that are listening, that this income is being removed from that portfolio, that's where the sequence risk really is magnified.
Interesting. I don't really hear much about sequence risk. Do you feel as if it's just not talked about nearly enough as it should be?
I agree with you. I don't think it's something that many financial advisors talk about. I do believe there are a number of financial advisors that really do take a look at that and really try to find ways of mitigating some of that sequence risk. But I don't believe that the media, I don't believe that the press, I don't believe that they make enough about sequence or enough noise about sequence risk to really put it on the forefront.
Right. And we often talk about, and I've done some studies on about that 4%, earmark. Investors can take 4% out a year and they shouldn't outlive their money unless, of course, market goes haywire and we have a lost decade. Um, do you think, obviously sequence risk even puts 4% at risk?
It does, because if you think about what you're doing, right? So let's use exactly the scenario that you just described. If I'm and again, keep in mind the scenario I used did not have a negative return,
Hmm.
right? It was 0, 3, and 6. But if I started at 0% rate of return and I'm pulling out 4,
Yeah.
then next year I'm doing that again. And the next year I'm doing that again. If I'm pulling out 4%, right, of that principal, but I'm not able to replenish it, right? My assets are now being depleted. I still need that, if let's say it's $1 million that we started with, the 4% rule would say, take $40,000 out, right?
Yep.
If you're adjusting for inflation, it gets worse,
Yeah.
but I still have to live. I still need to pull out $40,000 each year. What that's now going to do, it's going to be creating the situation where I'm depleting that account. And then to get that same $40,000, that means the percentage of asset that I'm removing, especially as I get into years
Yeah.
6, 7, 8, 9, 10, will be that much more. That eventually that's where it's depleted, right? The 3% ain't going to cover it in that 4% rule either. By the time I get to 6%, my assets are so far depleted that it's not going to make a difference.
Yeah.
I'm probably going to go broke somewhere in my 80s.
Scary. And then you definitely can't go back to work, right? Um, if you're 60 something, you could possibly go back to work. 80s, it's much more difficult.
Yep.
Yep. We talked about risk, sequence risk there. What are some mistakes investors make in retirement? We often talk, they spend too much or they're traveling too much, or maybe there's some other mistakes that they might make that we don't think about.
Well, there are a couple of planning mistakes that we could take a look at in a moment. But what's really interesting is that one of the things that we find is many retirees are actually on the other side of the scale. We typically think of the risk being that you take out too much money, or you're spending too much, and that is a risk, right? So if you are going to just figure that you could just spend as much as you can, you're going to run out of eventually you're going to run out of money. So working with a financial advisor to budget your retirement is so critical, right?
Mhm.
The other mistake that we see constantly is the retiree that decides, you know what, I have all this time on my hands, I don't need a financial advisor. I'm going to do it on my own, right? We, we there was one situation last year where I was in a meeting with a financial advisor and their client. It was a husband and wife, and she literally said, "I pulled the plug out of the computer because we cannot lose any more money." Because what they do is the concept is, now I have all this time on the world in the world, so now I can manage my own investments. Well, everyone who's watching this program knows that it's years of study, it's the experience. You don't just all of a sudden retire and now you're going to manage the assets. And to me, that's a critical mistake, thinking that now I don't need the financial advisor.
It's interesting. I often go back to, you mentioned it, the great financial crisis, and before that it was more about, how much money did you make, what's your, or what's your rate of return, and talk in the clubhouse and all that stuff about, I made 10% this year. But after the great financial crisis, people, I think, really took a step back and they were like, okay, we need to focus on goals, more focus on financial planning, because does it really matter if you need get 10% return when all you really need is 6 to retire. And feels that financial planning and became so much more important after the great financial crisis, and hopefully investors and the public realize that also.
Yeah, don't forget. So we came out of the 1990s. It was one of the greatest bull
Mhm.
market runs ever. And my old manager used to tell me, don't confuse brains with a bull market. In other words, anyone could make money when the markets are going higher. I think what 2000, 2001, and 2003 market pulled back 30+%,
Yeah.
and then the financial crisis taught us is that really planning and understanding risk and putting together sensible portfolios
Yeah.
that can overcome those type of markets. That's what's critical, and that's where the use of a financial advisor, I think, is just so important.
Yep. And it's like me. I uh, uh, hardly even know how to change a tire or change my oil. I'm not going to start becoming a mechanic when I retire just because I have time. I'm definitely going to continue to employ a mechanic, right?
Yeah.
Um,
So at my age, Automobile Club of America to change my tire, it's I make sure that I pay that dues more than my insurance policies.
yes, exactly.
I don't want to change the tire.
Exactly. You know, the wealth management space is more competitive than ever. So, how can financial advisors differentiate their practice from others and add value when it comes to retirement planning?
At Dunham Trust Company, what we do is we take a look at what the individual's family needs are before you go into the investment portion. In other words, especially when you're dealing with IRAs, as you know, IRAs are becoming a large asset. So at Fidelity, the number of IRAs that or millionaires that they have in IRAs or as participants in their 401k, based on their February report, has hit a new high, right? And that's just Fidelity, right? So think of all of the other Schwab and Merrill Lynch and Empower, right? Where you really do have millions of dollars in these retirement accounts. How many financial advisors are talking about their family, their client's family, or the prospect's family, right? So if as a financial advisor, if I'm going after a prospect with $2 million, $3 million in their retirement plan, right, in their 401k, and I'm trying to bring them over to my practice, right? If you're talking about your investment and how you invest and what you do and why it's different, right? You certainly sound a lot like everybody else. But think of this for a moment. How are you helping the family eliminate the Secure Act tax? As you know, in 2020, right, we had the stretch IRA became a dinosaur. It disappeared. Now the tax is due within 10 years, right? That the IRA owner passes away. Within 10 years, the custodian must distribute the IRA. What that could mean to many beneficiaries is that they're in the highest tax bracket, right? So think about it. The IRA, right? That you're leaving your children are the most tax toxic asset that you can ever leave to someone you love. Why? Because every other asset that you own gets a step up in basis. In other words, whatever my stock portfolio is, my daughter will inherit it. The value of those stocks will be the value at the date of my death. If she turns around and sells them immediately after, and the value's just about the same, she eliminated all capital gains tax. That is not true on your IRA. Now, you and I are both in California, so we pay ridiculous, income tax here in California. But I want you to think about this. For your listeners' clients, right? they have to understand there are really only three places that they can leave assets to. They can leave it to their family, they can leave it to a charity, or they can leave it to the government. Their job has got to be to disinherit IRS. Their job has to be able to make sure that the maximum amount goes to the children. So when you say what are the planning things, right? Well, start with the family. Start with the fact that in California, 37% federal tax, another 14.4% state tax, right? That gives the government here in California, that gives the government over 50% of my IRA, which means the government's going to get more than my two girls individually.
Yeah,
Is
that's
that
right.
what you want?
Yeah, it's definitely a motivate, and it's why taxes really are so important. And people, I think, especially when they get into retirement, should really consider taxes and trust. Estate planning is so important, and a lot of different things to consider versus just what mutual fund to buy, right?
Correct.
Um, you brought up the Secure Act. What I feel as if the Secure Act got a lot of press and then maybe the pandemic hit or something, but I don't hear too much about the Secure Act any longer. Is that something financial advisors should continue to focus on or?
Yeah, absolutely. It is a critical aspect, especially if you have prospects that you're trying to turn into clients. You need to understand what that did. And you Ryan, you raised a point that I think is worth noting. The Secure Act occurred in 2020, right? January of 2020. By February of 2020, we have COVID, and by March we're locked down. And I feel as if because of that, many financial advisors never focused on the Secure Act and what that means in terms of taxation to the children of those clients, right? And for those of you that work with centers of influence, the CPA that you're trying to get referrals from, boy, if you can talk to them about the Secure Act, and if you can talk to them about using trusts to eliminate the Secure Act tax that the children will be facing, right? I think that's going to have the CPA want to talk to you a bit more about it. I think it's the type of thing that they would like to speak to their clients about because they're faced with the same issues we are. It's a fee business that they're in. They have to justify the fee that they're charging to create the tax return. So if they could also tell that client after tax season, but if they could tell the client, listen, we need to look at this, and I have a financial advisor who's really good at understanding this, I think that it could lead to referrals with those centers of influence.
Yeah, those center of influences are so important, right? Just also, as financial advisors, you don't need to be, let the professionals on taxes deal with it, right? Same with estate planning and so on. Is there something financial advisors aren't thinking about enough about? You mentioned Secure Act, sequence risk. There's a lot. Maybe something else in the future.
Well, there is the sunset rule. So the tax code, as we know it, is going to be changing in 2026, and the impact is it could be a huge impact for those people that are high net worth clients, right? So in 2025, more than likely, you and your spouse will be able to have $14 million each that you will be able to leave to your heirs without any type of estate tax.
Okay.
When in 2026, right? Or late or around midnight of 2025 on December 31st, as you're counting down to the new year, right? And you go from 3, 2, 1. When you hit that moment, that we move into 2026, that exemption, Ryan, it's going to go down from 14 million each to 7 million each, somewhere around there, because it's $5 million plus inflation. We're assuming that's going to be around 7 million. The key is this: the penalty that you pay from a tax standpoint for being over 7 million is a 40% tax. Said differently, it's $400,000 that now goes to the government for every $1 million that you're over, right? So at $7 million, that means $2.8 million at the stroke of midnight. There's $2.8 million that suddenly is going to the government, right? And financial advisors need to start talking to clients about that now. If you wait, there are two things that are going to happen. Number one, by the time we reach September-ish of 2025, you will not be able to find an estate attorney that is, worth their salt, that will be available to speak to them, because they all are going to be busy, and you're going to hear things like, sure, give me a call in January. Well, in January of 2026, it's too late. So start today, to start discussing this. And my guess is you're going to see attorney fees going up slightly. The more they're in demand as we go into 2025, as we get closer to the sunset, I think you may start seeing fees for different types of trust and strategies that could be utilized in order to reduce the tax. You may see that fees going higher.
Yeah, that is a huge tax burden all of a sudden. Well, it's funny you brought up, New Year's, why everyone is popping corks of champagne. Little do they know that all of a sudden their taxable burden, or estate, limit goes from 14 million to 7 million as they're out celebrating. It's definitely something that I don't hear enough about or planning enough about. Obviously I don't have to worry about $7 million. I don't have that much for an estate right now, but very good to know.
Yeah, my $32 that I'm leaving my kids, I think they'll be fine as well. But they're dividing that between the two of them, by the way. But Ryan, the thing that your listeners should be really focused on is that you can gift some of those assets while the exemption is at that 14 million. Let's just focus on 2025, and let's assume that with inflation, it reaches that $14 million level. You can gift the assets in 2025. And in November of 2021, IRS said that if you do that, they will not come back and claw back the exemption if, when you pass away, the exemption is lower. So in other words, if I gave my assets to my girls, $28 million worth of it, I'm not suggesting that clients do that, but there are other tax strategies that we talk about at Dunham that can help help mitigate some of that. But let's assume for a moment that you just decided you're going to give the full $28 million gifted to your heirs, right? And then when I pass away, the exemption is $7 million. IRS is not going to say, well, no, really, your estate is 28 million. So, I mean, I'm sorry. So 28 million with husband and wife. So 14 million for me, right? They're not going to come back and say, wait a minute, you gifted $14 million to your kids, but now the exemption when you died, right, is really 7, right? So that's all you get. They're going to let you keep the full 14 million. So there's some really, really critical planning that has to be done between now and then to try to work out a nice balance between the gifting and just making sure that the tax burden isn't as high as it will be.
Yeah, very, very good points, Sal. That's fantastic. So let's continue with this estate tax conversation. Is there any estate planning strategies that might help limit tax consequences, like beneficiaries and trusts and estates?
There are. So there are there are a number of different trusts, but it all depends on the matriarch or the patriarch. In other words, what are their main objectives? What are they looking at? If they are charitably inclined, there are charitable trusts that we can be looking at. And through those charitable trusts, what we're doing is we're basically removing the assets from the estate completely, right? You have things, people talk about foundations and, starting a foundation and then you gift to the foundation, which means you're limiting your estate. You're doing, but what you, but you could look at donor advised funds in order to do that, right? If
Mhm.
you don't want to go through the expense and the IRS scrutiny of a foundation. So you can be looking at those type of strategies.
Okay.
There are many different types of trust where you can basically be utilizing the what we call estate freezing techniques. In other words, it may not be an asset that I want to give up. I don't want to give it to my girls, right? But what I do want to do is make sure that the appreciation occurs in their estate. So where there's a an asset that I believe is going to continue to appreciate, um, like a business, right? So maybe if I own a business and I know that the business is doing well, and I'd rather have the appreciation go into my girls, estate, not mine, right? You can do that as well. So yes, there are a number of different things you can do, but it's all predicated on the client, right? What is it that they want? What are they more interested in? Are they interested more in controlling the asset, right? More so than taxation, right? Because then those are different strategies that you'd have to look at. They may be more concerned about taxation, less concerned about control of the assets. Well, those are completely different trusts that
Right.
we would take a look at.
Interesting. Yeah. And it's so important, again, to, we all often talk about it, and hopefully financial planners and advisors do this, but how important it is to listen to each client, right? Because each client is unique in their needs and their wishes and what they need, and what they want. And you just got to know, what questions to ask and make sure you listen to those needs. Because trust, I've been looking in, there's some trust with my mom, trying to help her, and there is just so many options out there and so many strategies that it's important to listen to the client and figure out who's the best estate lawyer to help you with that.
Right, or even a advisor friendly trust company. So Dunham Trust Company is an advisor friendly. In other words, we're not competing with you
Mhm.
for the assets, right? Your listeners continue to manage the assets, but there are others, like us. You want to utilize those because we like at Dunham Trust Company, we'll work with you. We'll go through the planning aspect. If you want to, you want to have us on the phone with the clients, because we don't charge for that. If instead you're having these conversations about estate planning, different techniques, as you said with your mom, you have a whole bunch of trust. If you're going to be paying $650 an hour with an attorney to explain those trusts, how they work, why they work, and then the decision is, well, I don't like that one. Well, let's try this new one, right? Those hours will add up. So I strongly suggest just find an advisor friendly trust company that you can work with and start with them, right? And then obviously bring the attorneys in, because they'll be needed to draft the documents, and they may come up with an idea or two that actually might work for the client.
Interesting. So are there offices? Does Dunham have offices across the country, I'm assuming? So for example, my mom's in Wisconsin, so we probably would there need to be an office in Wisconsin, or at least licensed in Wisconsin to help her?
Yeah, so we can handle trust in any state,
Okay.
right? Where we're located, we have offices in Reno, we have offices in Las Vegas, we have offices in Colorado, and we're opening up a new office in Wyoming.
Oh, awesome.
But we
Make
could
those
handle
trips to
any.
Wyoming. Yeah.
Well, what a beautiful area it is.
Yeah. You have some fantastic places to go visit. That's
Yes.
for sure. All right, Sal, I think that's a great way to end this conversation. You brought so much insight. It was really fun. I learned a lot. I think the guests are going to, or the viewers are going to learn a lot too. Thank you so much, Sal, for coming on the show.
Well,
It
my
has
pleasure.
been a pleasure. Where can our audience get more information about Dunham?
So if you can either call our business development team, and they can be reached at 858-964-0500, or just our website is www.dunham.com.
Fantastic. I will also include that website in the show notes. So if anybody wants to follow up with any other questions or information about Dunham, they can find it there. Awesome, Sal. Thank you once again. That was a lot of fun. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much, and have a great rest of your week.
Thank you, Ryan.